So if you've been watching any of my other videos, you would have heard me talk about the idea about forecasting a high probability expansion. Now, in my personal opinion, the best way to actually utilize ICT concepts is to pull apart all the stuff that you like to use, the ideas around, let's say, power of three or order blocks or fair value gaps, and try and create a system around looking for or anticipating some sort of expansion in price that is repeating and that is something that can actually be forecasted. So you probably noticed, how to forecast high probability. So if you've been watching some of my other videos, you might have noticed me actually talk about the idea around a high probability expansion and your ability to forecast it. Now, in my personal opinion, the best thing to do with ICT concepts, the best way to actually utilize them, is to take them, join whatever concepts you want to use together, and then create a system around anticipating what we'd refer to in the ICT community as a low resistance liquidity run. Basically what that means is it's a run to some sort of target, whether that be buy side liquidity, sell side liquidity, or fair value. But the idea around it is it's pretty much a straight energetic move. It's not consolidating, it's not sort of bashing around. So look, let's do this, right? Try and picture what your ideal scenario. Let's actually work from the end. Okay, so your most ideal scenario in price, right, would be for you to enter a trade and it to skyrocket to TP, right? That's what we like, right? That's essentially what we're all aiming for in general. So to do that, you actually need to think about what are the key components that are actually going to go into that. Okay, and that's what this video essentially aims to do. Let me just make myself smaller there. So my promise by the end of this video is that you will understand the key components that make up a high probability expansion in price. Of course, this is just my own opinion. If you have any others, drop them down in the comments. If you think I missed anything, I'm all ears. So the titles of this video, I'd say, look fairly basic, okay? But I've thought long and hard critically about a lot of these individual topics. So there'll be a lot of things here where you might understand, let's say, the time element, right? I'm assuming most people would understand kill zones, blah, blah, blah. But what I'm going to actually do is I'm going to answer questions you may have not actually thought about before, i.e. why are we trading in these times, this sort of thing, right? Even with liquidity, obviously everyone knows what buy side, sell side liquidity is, but I'm actually going to go in depth with understanding order pairing, all these type of concepts and ideologies. So let's have a look at the time element first. I've split these into three sections, okay, but you have sort of these key timings in price, right? You have Asia kill zone, you have London kill zone, you have New York kill zone, you have AM session, PM session, these are technically kill zones as well, and then you have macros. Okay, macros are the last 10 minutes of an hour and the first 10 minutes of the following hour, and I've done an example macro there, which is 9:50 to 10:10. That is a signature macro in regards to indices, which is, again, popularly used. Okay, but the main question you actually need to ask yourself here is, why does this time actually matter? I know a lot of people will break this down with regards to stuff like quarterly theory and all that type of stuff. I'm not interested in any of that here. Okay, what I'm interested in is trying to understand, why do we actually trade these specific times, right? That's sort of the question I thought to myself first. Now, what do all these have in common, right? What does Asia kill zone? What does London? What does New York? What does AM? What does PM session? PM session less, but what do all the rest actually have in common? Okay, aside from macros as well. These kill zones are actually referred to as London open kill zone, New York open kill zone. Okay, AM session is the start of New York Stock Exchange, right? So the key point here is all these kill zones actually line up with the opening of a particular institutional / bank / large financial entity. Okay, and I think that's where one of the keys are here. right? So these set periods are, like I said, the opening hours of the largest financial institutions on the planet. Therefore, we know liquidity is likely to be injected in those hours. Okay, that's point number one. Now, why is that relevant? For us to see a high probability expansion, we first need liquidity or volatility behind the move that we're attempting to trade. That's why we don't trade outside of certain hours, because we know, and if you've been trading for a long enough time period, you'll know that volume tends to be entered into the market around these specific hours. Okay, so that's number one. Number two, okay, this is another reason I think that's fairly overlooked, right? You might not have even thought about this, is by tracking and studying a specific window or time window, you actually become familiar with the patterns and possibilities that can occur in that specific time period. So what you're basically doing by trading the kill zones is actually getting really good at understanding what occurs at that specific set hours of price. So for example, let's say you become a London kill zone specialist now. You know that there's pretty much only two possibilities, okay? You're either going to sweep Asia and expand, or you're going to leave Asia unrested and expand, or London kill zone may consolidate. Okay, you really only have two functions, right? Now, that information in itself is useless to someone who hasn't actually gone ahead and back tested and been live in the present market, because how is the newbie supposed to be able to know whether Asia's going to get swept or Asia isn't going to get swept or we're going to consolidate? Okay, and that's why it's so important to actually be limiting your trading down to a specific time period so you can actually get good at that zone. Right, another option you have is to trade macros. Now, I don't personally trade macros, I'm aware of them, but if you don't know what macros are a 20-minute time period where the market supposedly is likely to spool, which basically means just run aggressively in one direction. Now, I have tested them vaguely, I don't really use them, so I'm not going to act like a specialist and pretend that I'm some sort of expert in macros. They are good, they are present in price, it's just not something I personally wanted to put into my trading. So with that knowledge, right, you need to therefore first of all define which time element you're looking to encapsulate your trading inside of. Okay, the other time element is the economic calendar, right? This is our roadmap. But why is this our roadmap? Now, this is our roadmap because those specific hours, those red folder news releases, we know are likely to inject volume into the market. Now, again, what did I say prior? I said that we need to know when market volume is likely to get injected into the market so that we can go ahead and catch our low resistance liquidity run. Now, the news pretty much only has two different functions. It's either going to manipulate and expand, or it's going to just expand. And again, you have the other one, which is the news may just do nothing, right? So essentially lead to consolidation. But 9 times out of 10, you're going to get some sort of movement. Now, with regards to actually placement of the news, for example, this week has majority of the news later on in the week, i.e. Thursday. So you may opt out of trading in the early hours or the earlier days of the week to then try and catch more of the volatility during the mid part of the week. So let's take a look at liquidity. Now, we understand as a very general basic concept that above every high and low, there is liquidity. Now, again, to the newbie, to the beginner, this is pretty much useless information. And I remember listening to ICT talk about this concept, and I thought to myself, I don't really understand how that's useful to me. How can I actually use that knowledge? But now let's actually take a look at this in a more contextual standpoint. Okay, and the big question we want to ask ourselves is, what is the purpose/function of liquidity to smart money? Okay, so let's say we have a higher time frame PD array here, the blue zone, and let's say price was in a sell model, gradually going lower, leaving highs above here, which obviously are areas of liquidity. Then around the higher time frame PD array, price ended up consolidating, building liquidity above and below the market. Now, what does that actually mean? Well, that means is that support and resistance traders, okay, are entering or leaving their limits above and below market price. So they'd have, for example, a sell stop beneath these lows, and buy stops above these highs. Now, if you never traded with a sell stop, because again, it's very likely you would have never traded with a sell stop. When I initially started trading, I actually did trade support and resistance, and what you'd actually do is you'd identify a consolidation. You'd identify maybe 3 taps of this resistance line here, and when that resistance line was tapped again, you'd anticipate price to actually break outside of that range and run lower to just some sort of imaginary target. So what actually happens here typically, right, is price will run above to trip out potential buyers above here and then run lower, sweeping out the low. Okay, but we won't focus on this liquidity above here just for this example. So price runs lower. Now you have all these guys who are in their short position. This is a risk reward tool. This is basically what my risk reward tool looks like. This is the entry. This is the, let's say, the SL, and this is the TP. Obviously, they're just imaginary, just as an example. So we've ran lower. Okay, all these guys that were looking to buy, obviously not going to look to buy anymore because their consolidation had already been broken out of. They would literally have set sell stops and buy stops. So once their sell stops get activated, it's likely they're going to get rid of their upper positions. Okay, so now they're in sales, right? But what does this mean to smart money? Well, smart money understand that we've tagged a higher time frame PD rate. The context of this would be that we're in a higher time frame buy program and price is aiming to make a higher high. So that's why we'd actually be looking for buys inside the higher time frame PD rate. So higher time frame PD rate gets tagged, and this is where smart money are going to look to get into their positions. Okay, so what they understand is beneath this low is a liquidity pool. Once that low gets tagged, the liquidity pool is now active. So this liquidity is actually offered as a counterparty for smart money's position. So let's understand it like this, right? Smart money are going to enter in positions so large, they're going to end up essentially moving the market. This is how I got taught the idea. So if smart money, okay, are looking to get inside of positions, they need counterparty liquidity. Okay, what does that mean? They need a large group of traders, or a large group of, they need money on the other side of their trade to be able to enter into their trade. So when you're looking to enter your trade, right, you need the necessary liquidity on the other side of the market. You need that group of traders who are essentially betting against you. Okay, so that's what happens here. This retail pattern is used to build liquidity on the other side of the market, is to generate a ton of sellers so that smart money can come in and drop their large positions using the liquidity of the other guys. So this liquidity pool gets tripped, and now when price runs higher, let's just for argument's sake say that SL was a little bit higher. When price now goes higher, all these guys, these retail guys, are now in drawdown. Okay, so that means that it's likely that price will not want to return back to this level here, because if it does return back to there, these guys will be able to break even on their positions. Okay, now the next thing to think about is after this counterparty is offered, where is smart money looking to offload their positions? Okay, or where can they offload their positions? Well, it would be above old highs. Okay, why would it be above old highs? Because we understand that above old highs rests liquidity. What does that mean? Above old highs rest some sort of level of buy stops. So when price meets these old highs, there are already willing buyers to buy back the positions from smart money so that smart money can actually exit their positions. And that's why when old highs are taken, you often see a minute pullback. So in this section now, I'm talking about the necessary tools that can be used to actually forecast that expansion. Okay, so now this is my short form checklist that I personally use inside of my model. Okay, so the key things I'm looking at are: has the market taken liquidity, and does it have an obvious drawn liquidity, which has to be a fair value gap or a liquidity pool? And then where are the willing buyers and sellers to buy back my position from? So once I'm in the position, that's basically where is my exit. Okay, Next, I'm looking at, can I forecast the expansion of a daily H4, H1 candle? And then does this expansion coincide with one of my daily profiles / cycles, which I talk about inside of my VIP group. Then at the bottom here, I've basically got what I'd like to see from a technical standpoint on an intraday perspective. So for basically some sort of filled FEG plus an entry model, or a tapped FEG plus CSD plus entry model. Then we need to look out for roadblocks, which are basically like opposing FEGs. Again, I've got a point on that in the PowerPoint that I'll talk about. So how do we actually go about understanding or finding a low resistance liquidity run? The first tool you're obviously going to use, and again, I know this is very basic, but I have to touch on this. On the left, we look at premium and discount. So for example, if we're in a buy program or if we're in a bullish event, it's likely we'd want to buy from a discount. Vice versa, if we're in a sell program, we'd like to look for sells or shorts in a premium. And then on the right here, I've just drawn up the PDRA matrix. So as price progressively travels up the premium matrix, you can look for each of these array in this order to find what you're looking to essentially short from, and vice versa with the discount arrays. The next point is whether we're in bullish order flow or bearish order flow, which is also known as buy and sell programs. So on the left here, we have a buy program. Price will seek old highs as targets and bearish fair value gaps. We also have the sell program, where price would like to seek old lows and bullish fair value gaps. Now with the buy and sell programs, that's essentially going to identify direction for you. What time frame to use this on? I'd stick to monthly, weekly and daily first to actually be able to gauge where you're going, and then from there you can use intraday to align yourself with the higher time frames. So let's actually do an example. Okay, let's have a look at something. This is a trade that I'd take myself. This is a trade that I've taken many times, and this is how I'd personally structure these price action material, price action concepts all together. So here we have price in a buy program. We're making higher highs and higher lows. Price has from low to high came into a discount. Okay, liquidity was taken. Okay, so this swing low after a higher time frame PDRA was met, which is the FEG, and the FEG was actually filled. Okay, so if you understand and you look at this, right, what's actually happened here? We're in a sell program. We filled an FEG under liquidity, and this candle here has actually filled the FEG and expanded higher, closing above this down candle. So now what I'd be thinking is, where is the next candle likely to expand to? Okay, so if, for example, smart money has accumulated underneath this low, it's used this low as some sort of counterparty, we've then accumulated orders underneath here, where is price going to look to offload their positions? Well, it's going to be above this high and this high. So very easily, let's just say this is the daily time frame, for example. I'm going to look for the day to open up, actually travel against me. Again, watch the Power of 3 video if you want to understand why that is. You're going to look for price to travel against you, the Judas swing, and then extend higher. And inside of that, I know that we're likely to get that low resistance liquidity run smoothly to go and take out these heights like that. So now let's actually move on to the monthly, weekly and daily profiles. So the first thing I like to do is actually start on the higher time frame. Let's say this is a monthly chart, okay? And I understand, right, and you can actually go ahead and do this in your own charts. If you go on the monthly, you will see, okay, there's only 3 things that can ever happen, right? You're either going to reach for both previous candles high and low. The candle's either not going to sweep previous highs, the candle's high or low, or it's going to reach for one side. Now, if you actually tally up which happens the most, you will notice that majority of the time, one side is reached for, essentially. Okay, so in this example, right, let's say the monthly candle looks like this. We had the prior candle being bullish, then this month's candle being bearish. Just in terms of proximity, okay, meaning what or whether previous candle's low is closer or previous candle's high is closer, where could I identify a potential drawn liquidity? Well, obviously it would be PCL, right, previous candle's low. So just based on the idea of proximity alone, you can have a drawn liquidity as previous candle's low right there. and therefore in this example I'd anticipate the previous candle's low to get reached for like this. Now with regards to the monthly, we have three different profiles. We have the classic expansion, we have the midweek reversal, and we have the consolidation reversal. Now there are more profiles than this. These are just the three that I personally use, but being able to use this really does help understand where price is likely to expand to. So for example, let's say we're in a buy program. Let's say we understand price is bullish and we're looking for this current week that we're trading to expand higher. Okay, Monday opens up, Tuesday sweeps the low into a higher time frame PDRA. That means with a strong conviction we know that Wednesday is very, very likely to expand higher. Okay, same thing with looking at consolidation reversal. Let's say we refer to the economic calendar and we notice that there's some sort of high impact news like CPI, for example, lands on a Thursday, okay, and there's no news Monday, Tuesday and Wednesday. Then we could potentially anticipate price to bang around for 3 days and then reach for the higher time frame PDRA. Let's say Thursday goes and tags that level and then expands higher, but price hasn't yet met any counterparty liquidity to offload smart money positions. Then we can confidently look at Friday as an expansion and that low resistance liquidity run. Now going a bit deeper into daily profiles, we look at the relationship between London and New York. Okay, so what I'd do is I'd go ahead, and obviously this would be, I guess, homework for yourself, is to actually go and look at the relationship between London and New York. Okay, now I'm going to give you the most typical relationship there is, and it's basically that when London continues in one direction, New York is likely to retrace into an OT and continue that direction. Okay, but the main key point is as long as major buy side liquidity in this case hasn't been met. So let's say down here off the screen, right, smart money has entered their longs, and that was Thursday in a consolidation reversal cycle. Let's say today's Friday, for example, Asia consolidates, London sweeps, London expands, and we haven't yet reached some sort of major liquidity target. Then we can anticipate New York to sweep some sort of liquidity, which we have here, maybe tap into an FEG, which will often line up with an OTE, and then see New York expand higher like so, right, to the major buy side liquidity. Now that's just one relationship. There are a ton, right? In the prior video I talk about New York reversal. There are a couple other profiles that I use, and to be honest, those are sort of like my bread and butter profiles that I use throughout my trading. I always like to profile my trades with some sort of daily profile, just so I have some sort of framework behind them. And the reason I do that is because those cycles are back tested, and I know that if price is following that movement, that it's very likely that we're going to see sharp aggressive moves. So finally, let's have a look at low resistance liquidity runs and roadblocks. Okay, so on the left and on the right, we have two pictures. We have on the left high resistance liquidity and on the right low resistance liquidity. High resistance liquidity is basically when we sweep out a prior low and then we get a move to the downside. Low resistance would basically be when price is just mitigating without any major liquidity sweeps. So the best way to actually look at this is when price wants to run back above these levels, is going to find it very difficult to actually get past the high resistance liquidity. Okay, whereas when we have low resistance liquidity, when price looks like this, okay, price will often just run through that. Now this is quite key because this alludes to the idea around roadblocks. Now if we want to see a low resistance liquidity run on price, but you notice that this is in the way, then often you can look to potentially TP. Let's say there'll be an FEG that lines up with this high resistance liquidity. You can often take partials around this area knowing that price may struggle to actually get past this level. However, when you notice low resistance liquidity here, then you can often just opt for the TP above all of the highs, because you know price should easily just run through that level. So the only two things that are ever going to cause a retracement or a reversal in price is one, liquidity, and two, a fair value gap. So let's have a look what this looks like in picture format. So I've brought back this image, but I've actually shown it more in a market maker buy model type program. So we have the original consolidation, we have an area of distribution, and we have first stage and second stage accumulation. So in this example, like I said before, smart money has paired its orders down here, and it's looking to offset those positions at old highs in price. Like I said before, every time we reach for an old high or reach above some sort of high or double top or triple top, price is often going to lead or allow for some sort of retracement as smart money is offloading their positions above these highs. Now, if you couple the idea of old highs plus fair value gap together, then you're going to get a really powerful draw on liquidity, and often you will need to anticipate some sort of retracement away from these zones. For example, if I do enter, let's say, around here at the first stage accumulation, and we have a old high with a fair value gap above, I will never underestimate this zone. I will 9 times out of 10 always take profit at this level, because I don't know how much of a retracement this area is likely to yield. Now, it's actually really important to understand what can actually stop or prevent your trade from moving in your direction. So this is how I'm actually effectively able to tape read, is because I understand that once we do take out counterparty liquidity, or where smart money is likely to pair their orders with, I know we're likely to suffer some sort of retracement. Now, that retracement isn't always perfectly measurable. Okay, that retracement could be beneath this low and then a total sweep higher. That retracement could be just very shallow and then a push higher. And this is a big thing. I think this is where traders sort of mess up a little bit. When they reach these roadblock type zones, you need to take profit, because the measurement of the retracement isn't always gaugeable. Like, you're not always going to know how far the retracement is going to be. Often you're not going to know at all how far the retracement is going to be. So that pretty much wraps up the entire thing. I hope you guys actually gained some value from that. If you're looking for some more content from me, okay, for example, if you're looking for more ideas around or information around buy and sell programs, or you want to see my personal daily cycles, hit the first link in the description and all that information will be there. When I ended up creating this program, the idea around it was actually to be able to equip a trader with everything necessary to see results, right? We create a very structured approach, i.e. do this, do that, follow this process, follow that process, right? And you'll see that throughout my videos. I'm very meticulous. I like to be very planned and have a process behind everything that I do. So yeah, if you're interested in that, then yeah, go ahead and click the first link in the description. Otherwise, I will see you guys in the next video.